Bloomberg now reports that 42% of America's small public companies are losing money as they collectively face a $600 billion wall of debt. With inflation driving interest rates higher for longer, many will not survive. A few days ago, Bloomberg wrote about this wall of debt, their term, hitting the 2,000 firms that make up the Russell Small Cap Index and that collectively employ millions of Americans. In total, they've got $832 billion in debt, of which fully 75%, so $600 billion, is due in the next 5 years. That matters since the Fed is now saying high interest rates will keep going because they failed on inflation, meaning expensive debt will keep going. For comparison, big firms have just 50% of their debt due by then, since big companies can get sweetheart terms on their loans. Bank of America estimates that even if rates stay where they are now, so even if they don't rise to match inflation, small cap earnings will drop by a third as their old debt rolls into new, pricier debt that will send many of them under. It is particularly tough since smaller companies tend to be more vulnerable to economic cycles, the boom-bust. In fact, thanks to the Bidenomics miracle, their sales are all but dead. In the first quarter of 2024, revenue among those 2,000 small caps rose just 0.3%, which is 13 times less than big companies. Keep in mind, inflation over the quarter did 1.1%, which is about 4 times higher than sales growth. In other words, sales among the 2,000 small cap firms are actually shrinking after inflation. With markets now expecting an economic slowdown, bets are open whether it'll be soft or hard. This has gutted small cap prices. They're below where they were in year-end 2021, so that's going on 3 lost years, even as the big companies in the S&P 500 have gained 14%, led by the so-called Magnificent Seven of big tech stocks, who themselves have gobbled up 90% of all the gains in the S&P 500. So yes, the stock market is becoming a pyramid with fantastic wealth at the top, and it quickly fades into the gutter. In fact, small caps haven't been this cheap in decades. Going by price-to-sales ratios, so how much the company is worth per dollar of sales, they're worth barely half what they were 10 years ago. So what was a $1 million company in 2014 is now a 50-cent company and falling. So what's next? Brought to you by Unchained.com. Most of the misery at the bottom is the Fed-driven financialization of our economy, where sweetheart financing of the big boys gives them an insurmountable edge to compete against the small companies. But some of it is a direct legacy of the Fed's cheap money policies, which pushed down interest rates and fed money to companies that never should have gotten money in the first place. Of course, this starved other companies of capital, a mom-and-pop restaurant who could not get a loan because the money was going to yet another Uber for dog treats gift box startup. Those malinvestments are now being liquidated and apparently have spread to 42% of America's small caps. As one Miton analyst put it, you've had a lot more companies be able to go public that will never make a profit. In theory, the market sorts it out, killing off the mistakes and shifting capital and workers to the solid companies. Of course, the modern central bank playbook is to do everything possible to stop that, shifting the U.S. economy towards a Japan-like zombie economy made of companies barely holding on, living paycheck to debt, paycheck like junkies. All the while, those millions of workers who neither understand nor care about any of this are left to dodge the fallout. Okay, we'll be watching. See you next time.